Welcome to the Investors Trading Academy event of the week. Each week our staff of analysts and educators tries to provide you a better understanding of a major market event scheduled soon, and that will have an effect on the global markets. If you thought the fourth quarter earnings season that just ended was miserable, brace yourself. The next one will be a real doozy. Earnings season unofficially kicks off the week of April the 11th, when companies including Alcoa and JPMorgan Chase report. S&P 500 companies are expected to post their fourth straight quarter of earnings declines and fifth straight quarter of sales declines. The last time earnings fell for such a long stretch was the period between the fourth quarter of 2008 and the third quarter of 2009, right after the financial crisis. And stop blaming energy. This time the pain is more evenly spread across sectors. What's been driving much of the decline in S&P 500 profits is no secret. The energy sector continues its losing streak, but this time the estimate for profit declines adds a certain level of sticker stock. Oil and gas company profits are slated to fall by approximately 99%. These steep market value losses sustained by the sector have diminished the overall weighting it carries in the index, but according to S&P Dow Jones indices, it still had a 6.6% weighting as of the end of February. Given the severity of the expected fall in energy sector earnings, along with the weight the sector carries, overall S&P 500 profit declines would be limited to just 1.8% if the sector were excluded from calculations versus the drop of 6.9% overall. S&P 500 companies are expected to show an overall earnings decline of 8.5% and a sales decline of 1.1% for the quarter compared to the same quarter a year earlier. China will no doubt show up in many earnings reports as companies update investors on how their business is performing there. China has transformed from being mostly a source of cheap goods and semi-finished products for US companies to a promising market with a burgeoning middle class that is now embracing consumer goods. China's slowdown is one of the reasons for the global commodities rout of the last year, as it is a major consumer of oil and metals. It is widely held to be the economy Federal Reserve Chairwoman Janet Yellen was referring to in comments this week to the Economic Club of New York that the Fed was taking a more cautious approach to rate hikes because of worry about global growth crimping US growth. Of course, companies don't operate in a vacuum, and they will be impacted by bigger picture or macroeconomic developments across the globe. Many economists are predicting a slowdown in US and global growth. However, with US stocks now easing their losses for the year, outright monetary easing by prominent central banks, and a Fed that has signaled it may be more accommodative in its own monetary policies, attention may now turn toward the health of corporate fundamentals.